be meeting in person, but also cost us one of our speakers. Tilvan Wachter will not be able to be with us today. So what I'd like to do is to start with just, I suspect most of the people who are joining for this session have a general idea of what work sharing is, but just in case, I wanted to spend a few minutes talking about work sharing and what it is, and then turn to our speakers. Let me just pull up my slides here. So what work sharing is an alternative to layoffs for firms that are experiencing a temporary reduction in demand. And the way that this works in the US context is in states that have a work sharing program as part of their unemployment insurance system. If the firm experiences a reduction in demand, they can apply to the state employment security agency to set up a work share plan. Under that plan, the firm would cut hours for workers in the work share unit by some percentage. Those workers would be paid for the hours that they worked by the firm, and then they would receive prorated unemployment insurance for the hours that they weren't working. Under US law, they would keep their health and retirement benefits. So for example, a firm with 10 employees that needed to cut its hours by 20% could either lay off 2 employees. Those employees would receive full unemployment benefits, but they would lose their health and retirement coverage. Or the firm could choose work share, under which the hours of all of their employees were cut by 20%. Each of those employees then would receive 80% of their normal pay and 20% of their full unemployment benefits, along with their usual health and retirement benefits. Work share can be beneficial both to firms and to workers. Workers avoid layoffs and the risk of long-term unemployment. Firms avoid the need to recruit a new workforce when demand returns to higher levels, though they do in the interim bear higher health and retirement benefit costs than they would if they laid workers off. Work sharing is an optional component of the US federal state unemployment insurance system. Although it's been around in the US since 1978, at the start of the pandemic, only half of states, accounting for about 70% of population, had work share programs. Historically as well, these programs haven't been much used in the US, even where they exist. They've been much more heavily used in the European context. But just to give you a bit of a flavor for this, these are data from the reports that states file with the Employment and Training Administration. What this chart is showing is work share claims as a share of all regular state UI claims for the week ending July 25th, 2020, which was the point during the pandemic when work share use peaked. As you can see, there's only a handful of states where work share claims represented more than 10% of total claims. And if you were looking at this on a full-time equivalent basis, it would be even smaller because by definition, work share isn't full-time. Just to contrast that with what has gone on in Europe early in the pandemic, again, if you looked at the share of the workforce that was on unemployment benefits versus the share that was on some form of short-time work in many of the European countries, the share of the workforce that was on short time was far higher than in the US. So there's a lot of reason, I think, to be interested in questions related to the use of work sharing, why it's not higher in the US, what the consequences of work sharing are. And that's what this session is about. We had 4 papers scheduled for the session. We will be able to hear 3 of them. And we'll be hearing first from Heather Grob at St. Martin's University about Washington State's Workshare program. Susan Houseman from the Upjohn Institute will be talking about some research she and I also was involved in this, have done on short-time compensation use in the US. And then Giulia Giupponi from Bocconi University will be talking about a new paper focused on the question of whether we should be insuring workers or jobs during recessions. So I am very interested to hear the presenters, and let me turn to them. Heather, you are first up. And you're on mute.
All right, okay. It wouldn't be a Zoom session if somebody wasn't, right? Let me go ahead and share my screen and try to get to the, there we go. Hopefully you guys are all seeing it soon. There we go. Everybody okay? Seeing it? Okay, great. All right. So thank you, Katharine. And I'm really pleased to be among this esteemed panel to speak about a program I probably know a little less about than the rest of our speakers. But it's one that I'm really interested in. And really from the standpoint of someone who's studied multi-employer insurance arrangements for a lot of my professional life, I became interested in short-time compensation or work-share as a possible viable alternative to the very negative effects that job separation can have, and particularly among people of color, and for those who may be from less advantaged backgrounds. And so I've often wondered, what if our system could be a little more like maybe like a beneficial hiring hall and less like an on-off switch? I also have the privilege of living in the great state of Washington. And like many of you, I've been a little more locally situated in this home state than I would like, but I do count it among my many blessings that I work in a job that allows me a lot of flexibility. And coming from a small private teaching institution, I'm really also very grateful that I still have a job. So we actually were looking at using Workshare during the pandemic for some of our professors and staff at St. Martin's University. The institution chose not to do it, and hinting at some of the reasons why later in my presentation. I'd also like to recognize the fact that I'm speaking from lands where the Nisqually people have lived and fished for time immemorial, and where St. Martin's Abbey monks endeavored to welcome all in the spirit of Benedictine values of openness and respect for all persons. I recognize the Nisqually people and the heritage in a spirit of inclusion, openness, and invitation for dialogue. Okay, so to start, I know that Dr. Abraham discussed this, but short-time compensation is actually a really small part of the overall unemployment assistance and pandemic assistance. And the number of short-term compensation claims here, you can see it's really, really small. It's this green here compared to a lot of the other kinds of regular state and extended claims that are available. But we think that it might be better to maybe use these programs a little bit more. Here you can see, this is just, the same graph, but you can see these very large peaks that we saw during the pandemic. And so one of the things, and this was certainly clear in Washington State as well. So what I'd like to do in my presentation is to just provide a little bit of context for the eligibility and historic use of short-time compensation in Washington, using some of the Department of Labor data, and the timing of COVID-19, the importance of short-time compensation during the pandemic. I think one thing that's really important that we might not get from looking at data necessarily is to look at the role of governors' proclamations and legislative changes in relationship to other kinds of worker protections, So for example, Washington State is a very generous system. And so we have a multiple kind of interrelationship of a lot of different other kinds of coverage during the pandemic, for instance, paid family medical leave, and a pretty generous workers' compensation system as well. And those are important for managing the pandemic in terms of its effects on unemployment. So also to kind of maybe raise some questions for further research. Of course, part of our challenge is having enough good data as well, but thinking about the powers of government, the role of businesses and the role of workers and their representatives are also important. So Washington State's shared work program is similar in many ways to other shared work programs. We call it shared work in Washington State. The employers must apply to participate. They have to have at least 2 employees who are eligible. And so that's part of the sharing part of that, right? And to continue to pay for health insurance and other benefits while they're using unemployment insurance benefits. So also, if they're unionized, they need to have the approval of the union. Employees must be permanent and paid hourly or able to calculate salary as hourly. I had to practice that, salary as hourly. And being available for all work offered by their regular employer, but don't have to look for other work, obviously, while they're using these benefits. And they have to otherwise be eligible for UI benefits. Approved shared work plans may allow employers to reduce hours by at least a minimum of 10% and a maximum of 50% while their employees collect partial benefits. And there's a chart that shows how much they would be able to collect. The program can last 1 year. And it does have a maximum benefits payable amount. So employees who end up working fewer hours, in other words, they're drawing more from unemployment insurance, may run out of their benefits more quickly. And participants may be eligible for benefit extensions. The employers would have to reapply to the program. Same in Washington State, historically, short-time compensation has been a really small part of all claims in Washington State, but you can see that if you have your Zoom set up right on the right-hand side here, a huge spike during the pandemic of both regular UI benefits and shared work. And that increase in shared work, as Dr. Abraham mentioned, was not shared, across all states that have access to short-time compensation. So I was interested in looking at this. So you may have recalled that the monthly, weekly, if you look at it in terms of how much we're using short-time compensation in Washington State as a percentage of all claims, it was actually very large in that 1 month, but it was actually just 1 week that caused a lot of that increase. And so I was curious to find out why. So when you look at the weekly percentages, sometimes gives you a better idea of what might be going on. Just a little context, I think, is important in terms of looking at the timing of the governor's proclamations and the use of the program. Well, and I hope I'm not adding to people's collective trauma on COVID here, but just to recall that in January of 2020 was when the nation's first reported case was in Snohomish, Washington. So that's a fair degree north of me, but right along I-5. So people knew that this was likely to be spreading quickly. We went into military department state emergency operations level 1. The first reported death in the US in Washington was on February 29th, and Governor Inslee issued an emergency proclamation. You probably remember seeing coverage of nursing homes and so on that were affected by the COVID virus. this alien that we didn't know much about. So the pretty quickly, by March 6th, the workplace guidelines and UI were, the workplace guidelines were put into place, UI was expanded and strengthened, and workers' compensation was also expanded to first responders. Then we started to see the shutdowns of schools, of restaurants and bars. By March 18th, Washington waived and suspended the 1-week waiting rule for unemployment insurance. And Governor Inslee, whom you might remember was running for president as well, but he waived and suspended, or he instituted what we call the stay home and stay healthy order, which extended to May 31st. Then also pretty quickly after that, waived and suspended statutes on job search requirements. And then, of course, the CARES Act was signed and added more benefits to individuals who might otherwise not be eligible for unemployment insurance. During this time, I would say that that at least here in the state capital of Olympia, the main focus was not necessarily money or questioning the science, but saving lives. And the economy was subsumed to some kind of idea of morality, or at least respect for the living and for our elderly. And as I would argue it should be, Washington State, or at least our governor, didn't spend a lot of time trying to figure out how much this was going to cost. And so I think that's important as well to think about. So what to do about unemployment, though, it's a really terrible consequence also. So I just leave a quote up there that our health officer in Seattle said, basically that you can't bring people back from the coroner's office. You can address other things later, but the immediate emergency of the virus was something that we wanted to try to stem, and to put all of our resources into keeping people safe. But we did have, also looking at what to do about unemployment. That can be a very terrible consequence as well. And so fortunately, Washington State did respond quickly, including Workshare as an option. Our governor and the Employment Security Commissioner, Susie Levine at the time, had a press conference where they actually talked about the benefits of the shared work program and encouraged employers to take advantage of it. The US Department of Labor also was putting some changes into place, allowing states to choose a tax if to choose to waive the tax, I should say, if the statutes allowed for it, which we eventually did. And then in May, we started to have a partial reopening. In our state, like many states, that was kind of phased by counties. And then we found out, and this was hitting national news as well, that the fund was targeted by criminals, and many people were hit by this. And I myself actually had 3 fraudulent identity theft claims that were perpetuated from this kind of people think that was probably mostly an attack from outside of the United States. Basically, they thought they had at least 102,000 suspected fraud cases. So that was very unfortunate, and something I think that the state probably handled pretty well, but it cast a shadow on unemployment insurance in general. And it also made it very difficult for people to apply for kind of legitimate claims during that time. So, all right, so here's the thing that I think was probably the most impactful thing, was that Inslee announced that there would be state employee furloughs. In addition to some other changes that were happening for unemployment insurance, the state and the Washington Federation of State Employees entered into a memorandum of understanding regarding layoffs and expressly arranging for shared work program assistance. So, and then just to kind of continue out on the timeline here, the legislation extended statutory waivers and suspended and suspensions as well. Also, we started a food production paid leave program to help out. Washington State has a lot of food production, and we're actually one of the most trade dependent states in the nation. Just to kind of skip down a little bit, we ended up also suspending the solvency surcharge on UI trust funds. So doing that did put us into a worse position with regard to solvency of the trust funds. But again, hopefully something that can be dealt with after the pandemic is over. So, and it will be over. So the economy started opening up again. Our death rate, if you look at, I'm not saying that shared work is reducing death rates, but I think the combination of a number of things has helped to reduce the death rate in the state of Washington vis-a-vis other states. I wasn't really picking on South Dakota there, but at the time, they were the state with the largest death rate. And today it's, I think, Mississippi that is the largest death rate as well. Ours has actually doubled. So we have been hit really hard from the Delta and Omicron viruses as well. So, all right, so that's that story. And you can see that extending out some of just looking at the pandemic assistance, this is not short time, but just looking at the, still going on through 2020 and 2021 as well. And so here's the timing of kind of thinking about the, it was really July week 1 that had an especially large take up in terms of claims, but the full-time equivalent was unusually low. So that would suggest that you have many, many low hour reduction claims like one would see during a furlough. And so I think there were a couple things going on with these spikes. First, I think employers did see the second wave coming. And you can see down at the bottom here of this slide, I've included the 7-day case count for COVID in our state, that our second wave was quite large by comparison to the first one, which we thought was, or sorry, there's kind of the first one and then the second one. Anyway, I think that employers did see that coming, particularly restaurants. And since I don't have individual level data yet, I'm not entirely sure about that. But you can see that as soon as those furloughs were announced, and that there was a memorandum of understanding with the Washington Federation of State Employees, that just completely spiked up very quickly. And then eventually when that state employee, when their furloughs ended, we saw a return to something that might be a little more, I guess you could call normal. Still though, I think that our public employees are heavily unionized, and they were in fact entitled to benefits when their hours were cut. So the state was also able to seek federal reimbursement for that. So one of the questions we might have about our short-term compensation is, are these claims continuing out for a long period of time? Well, they are time limited, although they can reapply. So we are seeing a little bit of elevation, but we're still kind of working through the pandemic as well. So one of the questions then, I think that eventually, and this is going down, I tried to extend it out as far as I could, the data would allow. We're starting to see that tick down. And so I do think that eventually it's not going to be very dramatic in terms of having a lot of continued short-time claims or reapplications. And that's probably a good thing. That's probably what you want for Workshare. And so can we expand Workshare in Washington State? I think the answer is probably yes. We could have capacity for it. Another thing that Washington State and the governor did was to actually do a lot of quick staffing up of the Employment Security Department in order to try to handle all of the claims that they would have, including insured time compensation. But I think it's also important to look at some of the factors that might be leading to greater use of shared work in Washington State, besides the fact that the public employees were using it, was that we had, before the crisis, a really strong and generous trust fund. We had really good Workshare experiences during the Great Recession of 2007 to 9. So employers were talking about using this program, and a lot of chambers of commerce were urging people to use the program. We also in Washington State, we have very large businesses in Washington State. So, you think about Weyerhaeuser and Costco and Amazon and all those very large businesses. If they're using Workshare, they're probably going to have a lot of people who are applying for it. We have done a tremendous amount of emergency preparedness in Washington State. Part of that having to do with climate change. But also the fact that we have Mount Rainier in our backyard. And so we need to be prepared for climate or, just sort of natural disasters as well. So there's quite a lot of emergency preparedness that goes on in Washington State. We also have a higher rate of unionization, especially among state workers. We have an exclusive state workers compensation and paid sick leave and safe leave in Washington State, which is unusual. So an exclusive state workers compensation just means that employers either have to insure through the state or they have to self-insure. So it has a little more kind of heft of ability to impact employers more quickly in a kind of standardized way, I think. And then during the crisis, as I mentioned, not only was there a lot of staffing up, but their willingness to spend a lot quickly to help people. The expansion of benefits under the CARES Act allowances were legislated by Washington as well. And a lot of coordination between other agencies. There was a checklist that told people where to go to get benefits. Lots of labor union and workers cooperatives assisting claimants as well, and expansion of public employee access to benefits. So really, when you look at the number of short-time compensation states that did all of the following: waiving waiting periods, waiving the job search requirements, expanding unemployment insurance and short-time compensation, and advertising extensively, and they're still advertising a lot. All of those probably contribute to more usage of the program in Washington State. So in order to try to absorb this kind of shock and to expand short-time compensation, the resources that you would need would need to be quite large. And then there are a lot of questions about when you actually trigger some of those extended benefits as well. Okay, I saw your comment there, Catherine, so I'll just wrap up. Let's see, it's not going forward now. I'm not sure why. There we go. Okay, so some of the things that I think are really important for us to think about going forward in terms of looking at short-time compensation would be to consider the starting points of each state, the eligibility and generosity of those states, maybe really it's difficult to do, but looking at those kinds of emergency powers of the governors and the legislatures, I think are important factors as well. The generosity of other programs like workers' compensation and paid leave, the impact of extended and expanded benefits on normal or non-recession operations. So in other words, going into a crisis. Also employers' behavior in choosing reduced hours versus layoffs. And employers are really doing a lot of learning from each other about this. Workers being able to actually encourage short-time compensation over layoffs. And I would say that the evidence here is rather mixed. Not all unions are going to be in favor of short-time compensation. So I think that's an area that is maybe one that would be interesting to research going forward. And then also the capacity of state agencies to handle claims. Not all states were maybe in a good position to do that. So without sounding like a campaigner for Governor Inslee, I do think that much of the success in managing our cases has been pretty much due to some good and quick leadership and cooperation amongst many agencies, and also the kind of flexibility afforded by the state and its pre-pandemic relationships to federal programs. And we were actually recognized during the pandemic as being one of the best states to live in during COVID-19 with respect to the generosity of benefits and the ability to protect workers during the pandemic. So, so just to conclude then, I think that the data really only tells us part of the story. The policy differences are really great with respect to states' generosity and efficiency in providing benefits. We know it works because employers say it works in order to prevent job separation. But we really need to do a lot more in terms of looking at the kind of economic incentives that are created from it, and the timing of those kinds of triggers, and then when you sort of end or rescind some of the changes to the program. So we don't really know how well it works in terms of who's well served and who's not, or the level of union agreement. And we don't necessarily know what the long-term effects are, but many of our other esteemed colleagues are able to get at that in some better ways than I am necessarily so far. I'm still trying to work with the Employment Security Department, who are still very busy to try to get data, a data sharing agreement. So I'm looking forward to that when we're able to do that. So that's the end of my presentation. And I think Dr. Houseman will be talking about the interstate variations and effects on take-up rates, which is really important as well.
Thank you, Heather. Sue, the floor is yours.
On my share here.
Great. Thank you, Heather. Sorry, let me share my screen. Okay, and let me get into slideshow.
While Sue is doing this, let me just say if I'm going to hold questions until the end, but if people know they have questions that they want to ask one or more of the speakers, you can either put them in the chat or raise your hand. Sue.
Great, thank you. As Katharine said in the introduction, I'm going to focus the first part of my presentation on a study that I, along with several others, including Katharine Abraham, Frank Benici at Westat, Susan Laban at Social Dynamics, and Chris O'Leary at my institute did a few years ago, trying to understand, it was commissioned by the Department of Labor, trying to understand what were the barriers to use of short-time compensation. And then in the second part of the presentation, I want to apply what we learned from that Department of Labor study to the current pandemic situation and the use of Workshare during that period of time. So just by way of background, at the start of the Great Recession, only 17 states had a short-time compensation program. STC was little used outside of just a few states during that recession. And there was a lot of frustration amongst policymakers about the state and particularly the federal level with the fact that short-time compensation programs weren't being more widely used and arguably could have saved some jobs and smoothed the great pain that we experienced during that recession. In recognition of that, the Middle Class Tax Relief and Job Creation Act of 2012 included, it was a large bill, but it included provisions to expand the use of short-time compensation. And the idea was to help states be better prepared for the next recession, which turned out, as we know, to be the pandemic recession. What did it do? It was geared to expand the number of states with programs. It provided federal funding for Workshare benefits for up to 3 years. So this is, in this case, the federal government is actually paying all of the short-time compensation benefits for 3 years. It offered grants to states to improve their program administration and to promote STC and to enroll employers. $100 million was allocated for that. Many states applied and did, in fact, work to improve their administration and improve their outreach. And it funded a couple of studies designed to better understand and address barriers to use. One of those studies was ours. What we did was we conducted demonstrations. It was a multi-year project. We conducted demonstrations in Iowa and Oregon, focusing on the low employer awareness of STC or Workshare. So the motive, in terms of the motivation and goals for these studies, lack of awareness was among employers about the short-time compensation option, even in states that had it, and many states have had it for many years, was long thought to be an important reason for the low take-up in the US. So the demonstrations were geared to provide information about short-time compensation programs in Oregon and Iowa to employers. The broad study goals were to test the effects of these information campaigns that we ran on employer awareness and use of the Workshare programs in those 2 states. We also wanted to document the costs of these interventions. How expensive was it? These were really outreach programs that were run by the states. We assisted with those and helped them design them. How costly was it to promote these programs? And then finally, to assess other factors that might affect short-time compensation use. So also the interventions were designed to, were intended to serve as a model for other states that might want to promote the STC program. So in terms of study design, much of it was involved random controlled trial. We used RCT design in Iowa throughout the entire state. And in Oregon, we used an RCT design only in the Portland metropolitan area. Portland, if you are familiar with Oregon, is the major city by far in the state of Oregon. So the advantage of an RCT approach is, as all of us as researchers know, is to help control for differences observed and unobserved across treatment and control groups. And it facilitates the testing of interventions. It's widely viewed as the gold standard in study design. However, we need to recognize that there are disadvantages in many cases of running an RCT. In our case, it really limited the types of interventions we could use because we needed to be able to use interventions to which people in the control group could be easily excluded. Okay, so this largely limited us to mailings to treatment employers. So We also implemented outside of the Portland metro area in the state of Oregon, what we called our quasi-experimental design. We had a treatment and control groups, but they weren't randomly assigned. They were assigned by geographic area. The advantage of going to this is that it gave us a lot more flexibility in designing interventions and what we felt were the kinds of interventions that states would ultimately use. For example, going out and giving presentations to employer groups. It's hard to randomly assign who can show up at an employer group. So the picture at in the bottom left corner on your screen shows we hope shows that the comparison and treatment areas in the balance of the state, we assigned one large area to treatment and the other large area to control, to the comparison group. Showed that in the baseline, the number of STC plans operating in Oregon over time really were closely matched between the two areas. So in terms of the data that we used in this study, it was a mix of administrative data, surveys, and interviews. We conducted a short survey with employers 6 months following the end of interventions about their awareness of the program. And then we used these responses to this survey to test the effects of intervention on employer awareness. We also used administrative data provided by both states, detailed administrative data, to track the interest in and use of short-time compensation for 2 years following the start of the interventions. And finally, we collected information on other potential barriers to Workshare use through surveys of employers who had participated in STC about their experiences. And then we did some qualitative interviews with employers, semi-structured interviews with employers and UA agency staff to identify problems with the short-time compensation program, their understanding or impressions of what was working well and what wasn't. So this diagram, if you can read it, just sort of provides a picture of how our interventions worked. The top panel is the STC design. Employers were randomly assigned to treatment and control groups. The interventions were largely limited to informational mailings and emails to these employers. We also had information inserted into tax rate notices, into their UI claims notices that employers received. When they logged on to the state portal, employers in the treatment group would see a banner across the top that led them to more information and enabled them to participate in some webinars. At the end, we then evaluated awareness and interest and use in the program using the survey data and the administrative data I just mentioned. In the outside of the Portland metro area, as I mentioned, we had the treatment region employers and the comparison region employers, and there we had just the regular mailings and so forth, but we supplemented those with presentations at group employer meetings. We educated staff who were working in the treatment region about the program, and then they would be meeting and could talk to business leaders and legislators about in their region about the SDC program. And they also disseminated information in one-on-one meetings with employers and state staff. So it was just a much more broader effort to get awareness out. And then we evaluated outcomes in the same way as for the RCT. So in terms of findings, very briefly, we actually found quite striking increases with pretty modest interventions in increase in awareness. We found in Iowa over a 15 percentage point increase in awareness between treatments and controls. This is an RCT. I want to also point out how low the baseline awareness was. Only a little over 10% of employers in the control group had ever heard of the STC program. Those in the treatment group, that rose to a bit over a quarter, but still pretty low, right? So a very large increase with a modest intervention, but a second takeaway, apart from the fact that these modest interventions really increased by quite a bit, the employer awareness was the low baseline. Oregon employers overall were a bit more informed about their state's short-time compensation program, but still it was a minority. In the Oregon RCT, which was run in the Portland metro area, 27.5% of the controls compared to 45.3% of the treatments knew about it. So a very large increase for, again, a very quite modest effort cost-wise. And in the quasi-experimental design outside of the Portland metro area, we found over a 30 percentage point increase in employers' awareness. We also had estimated the effects on STC use resulting from the interventions. This again was a 2-year following employers across 2 years. What I'm reporting here are actually from difference in difference equations that controlled for other factors, employer characteristics, time period effect, fixed effects, and the like. And we found quite significant effects in Oregon. In our RCT, a 58% estimated increase in the probability of developing a plan, and 100% increase in our quasi-experimental design, where the interventions were somewhat, broader. We found no effect in the state of Iowa on plan use itself. One potential explanation, there's several, but one potential explanation for that is that the state economy was very strong and really growing, and was a bit stronger than that in the state of Oregon. Okay. So other things that we looked at in the study were the costs of using short-time compensation from the employer's perspectives. Employers did not generally report, and let me emphasize that this information was coming from employers who had actually used the program. Unfortunately, we didn't survey employers who didn't use the program why they wouldn't, and perhaps the answers would have been a bit different had we had a broader sample. But employers who used the program did not report administrative costs as a major impediment to use in our survey, though some mentioned the desirability of reducing those costs in interviews. Another cost to employers was potential impact on their UI tax rate. And so that is certainly one factor that came out, particularly in the state of Iowa, as being a potential impediment to employers' use. Just as laying workers off can increase an employer's tax rate, because we have an experience-rated tax UI tax system in the United States. Using short-time compensation can also raise rates, and employers can always cut back on hours without giving employees access to the Workshare program. So the impact on taxes was something that was a consideration for employers. Another cost to employers was that under Workshare laws, they must continue to offer any benefits if they offer them, such as health insurance or retirement plans. In terms of the benefits that came out from our surveys, a large majority of the employers of our employer survey respondents indicated that the short-time compensation was very important or important for their business survival when they had used it. It helped them maintain employee morale. meeting needs of employees and retaining and valued and skilled employees. So the people who responded to our survey were very enthusiastic overall about the program. They overwhelmingly said they would use the program again or recommend it to others. In terms of barriers to use from the state's perspectives, was that, and of course, as I'll mention again in a couple of slides, we heard this again in the pandemic, antiquated IT systems. These can be a barrier, not just to using the UI system, as we heard during the pandemic, but particularly for the using the short-time compensation program, which is more involved in setting up these plans. Unemployment insurance staff were concerned about being overwhelmed because of time-intensive nature that the STC plan involves in terms of the approval of the plan and the claims processing. And this was especially apparent in Iowa. The staff, in fact, did not allow large employers to change their STC hours from week to week because of the administrative cost to the states. Let me just back up and reemphasize a point, which is that unlike regular UI benefits where the employee goes to the state and applies for those benefits and is automatically qualified, the short-time compensation program is one that must be invoked by employers. And to implement a short-time compensation plan, they must work with the state to devise a specific plan for their particular situation. So it is more time intensive for the state to administer. So those were just a summary of some of the findings, some of the key findings coming out of our study, which that came out in 2017. Now I want to consider move forward in the second part of the presentation as to what was happening during the pandemic recession. Well, remember 17 states had at the beginning of the Great Recession had operating programs that was up to 26 at the start of the recent recession. The CARES Act and the American Rescue Plan contain provisions very similar to the 2012 legislation that I just that was enacted to encourage STC use. In a way, the similarity of those provisions is not surprising. If we all remember how quickly this pandemic unfolded. So the federal legislators were kind of grabbing what was off the shelf and inserting provisions into the CARES Act, and those many of those provisions were extended in the American Rescue Plan. So the federal government covered 100% of short-time compensation costs until September of 2021. I want to point out that this 100% coverage of STC costs made the program especially attractive to reimbursing employers, which includes many governmental entities and nonprofits. So for those who may not be that familiar with unemployment insurance financing, most employers, they pay like an insurance premium to the state. We call it a UI tax. And then that's how their benefits are funded through that tax, and they are experience rating. Just like your car insurance goes up if you're in an accident and it's your fault, for many employers, their premiums or their taxes, UI taxes, go up if more employees claim benefits from the state. However, there's also reimbursing employers who pay back the state directly. And those often are governmental entities and nonprofits. If you think about it, if the federal government is paying 100% of your STC costs, but none of your regular UI costs, it doesn't cost you. You don't have to reimburse for short-time compensation. So there were very particularly strong incentives for reimbursing employers to use this. And I'm going to get to this in a minute when I show graphs, but I think that was a lot of the spike in the use. I suspect it was as much of the spike in the use that we saw during this pandemic. Like the 2012 legislation, there were grants to states to assist with administration and promotion of short-time compensation. There was a federal option, only 26 states had it, 24 didn't. And so states couldn't set up a plan if they, it takes time to set up an approved plan through the federal government. In the meantime, there was a federal option by which the federal government would pay 50% of the benefits if states wanted to open up this opportunity for their employers. An additional feature was that many of us remember FPUC, the Federal Pandemic Unemployment Compensation, which was really a supplement to regular state UI benefits checks. Initially, it was $600 per week, a fixed amount. And then after July of 2020, that dropped down to $300 per week supplement. That was a very generous plan. It was implemented by Congress because it was believed that in many states, unemployment insurance benefits were insufficient to protect workers who suffered unemployment. Those benefits and the fixed levels were extended to people who were on short-time compensation. So even if your work hours were only cut by 20%, you still received up through July of 2020, the full $600 in benefits, made it extremely attractive to workers, right? Very generous. Also, the final thing I'll mention here on the policies that were implemented was that the pandemic unfurled so quickly. We went from very low unemployment to the highest level of employment recorded since the Great Depression in the 1930s in just a matter of weeks. And so employers, and much of that was because of mandatory shutdowns, employers were just shutting down and laying off workers. So many never had the opportunity to even consider short-time compensation. DOL issued some rules that actually allowed companies to hire back workers and put them on short time to clarify that it could be used for this reuse. The point here is that there were a lot of effort by the federal government to promote STC during the pandemic recession. Okay, so what did we see? So here's a graph that you've already seen variants of from Heather, but you do see much higher use of short-time compensation during the pandemic recession, much higher levels. These are the number of STC continued claims. This right here, this very peak, is the July, I think the week of July 25th that Katharine showed in her graph. So nearly a 500,000 continued claims, much higher than at any prior time since 2000, well, ever. It's interesting. I just want to point out a couple of things here. The week of July 25th was the last week. Is right before the very generous $600 benefits expire. Okay. And it was unclear at the time what would whether there would be any supplemental benefits. And we see STC use plummet after that, actually. The other thing that I want to point out is that from Katharine's diagram, Michigan was the leader in this, and Washington was number 2. I've asked around. I don't know of anyone who has data. You would have to collect it from individual states. It's proprietary. It's not published in the federal statistics system about which industries were using it. But I think it would really be fascinating in future research to get a hold of those and to see how many were reimbursing employers, how much of this was done in particular by state and local governments. I can tell you anecdotally in Michigan that a lot of the state employees were on short-time compensation during this period. And there were a lot of local governments, including my town, Kalamazoo, Lansing, and several others in the state of Michigan, that rather than furloughing employees, were just passing on payroll costs to the federal government. So anyway, I think this was a highly unusual recession. It would be interesting to dive into the numbers and figure out exactly what was going on with that peak. Okay, but my second point is that short-time compensation as a share of all claims was really not higher. Catherine and Heather have been pointing this out. It never got above 2% or stayed well below, although it was the highest it's been since the Great Recession. So much greater use, but of course, overall unemployment insurance claims were skyrocketing too during this period. So what were some of the impediments? Let's think about some of the impediments to short-time compensation use during the pandemic. Well, arguably, there was this great effort coming out of the Great Recession to advertise the program and to expand it. I think that probably did help with the take-up. But in 9 of the states, the program was not an option during the last recession, and undoubtedly, from the figures I showed from our study, employer familiarity and experience with the program was extremely low. Also, these recession especially affected low-wage service industries where STC use was historically very low. We know from prior studies that where the industries where it has been using, which is manufacturing and professional services, in this recession, the hardest hit industries were hospitality, brick and mortar retail, and the like. Additionally, there were lots of administrative problems with administering short-time compensation. Of course, the administrative problems that we saw in regular workers who are fully unemployed got a lot of press, but it was also the problems were as large, if not larger, in the administration of STC plans. As I mentioned earlier, these plans must be developed by a business and approved by the state that is specific to their context, how many workers they're going to have on short-time compensation, what the cutback is, how long they expect it to be. It's just a much more involved process. It's more daunting for a business to develop one if they've never done it before. And in states with short-time compensation, typically very few staff are trained to handle these plans. Think about the context of the economy going into this. We had very low unemployment, very low use of short-time compensation. When Katharine and I and others were working in the states of Iowa and Washington on short-time compensation, typically only a handful, under a half dozen, of people in the state were trained to do this, okay? And state staff were overwhelmed by the inquiries, and training new staff is very time intensive. To give an anecdote from the state of Michigan, which was actually trying to promote this during the pandemic, it was running webinars for employers and so forth. We were hearing, there were widespread reports of complaints of employers who then would get this information, say, this sounds great, going to the state, and they couldn't get anybody to answer their call, right? My institute, in addition to the research division that I'm in, also has an operations division that runs employment and training programs. Those were shut down. They were not operating during the worst of the pandemic. We didn't have in-person services. Some of those staff were retrained to do short-time compensation, but it took a couple of weeks to train those people. So all of this, the frustration, the inability of employers, even if they were interested in developing a plan, getting it through was, I'm sure, a big impediment during this pandemic. just let me mention a few other things. We need to remember that the federal government, as I detailed earlier, was really promoting in a big way short-time compensation. It was providing assistance for the unemployed and families through a variety of other programs that may have lessened the urgency to keep workers in their payrolls. For example, the economic impact payments. 3 of those went out to low and middle-income families. There was assistance to individuals having difficulty making rental or mortgage payments, expanded child care tax credit that was actually became a refundable credit, so reached even the poor. In addition, regular unemployment insurance benefits were quite generous for those who were fully employed, particularly during the period of time when the $600 benefit was available to all of those on unemployment insurance, so who were fully unemployed. The median worker at one point was estimated in the early part of the pandemic, the median worker, it was estimated the replacement rate was over 100%, meaning that the worker earned more on unemployment than on the job. We also tend to think, and this may have been the case, the generosity of short-time compensation benefits, meaning because they had this FPUC, this fixed pandemic federal supplement added to their paycheck that was made short-time compensation benefits extremely generous. We think that should have encouraged more use of short-time compensation. But I want to just raise the possibility, this is really just a hypothesis, I don't have any evidence one way or another, but arguably this may have deterred some employers from using the program. Remember, it wasn't the workers who decided whether they used it, it was the employers. And they may have, some employers may have worried about the morale effects of having workers make so much more in some cases than they earned on the job. And it may have deterred some of them from using the program. Nonetheless, we should remember that the levels of short-time compensation use were far higher than in prior recessions. And arguably, there was far greater exposure than we've ever had in the past during the pandemic. And this could lead to increased use in future recessions. So finally, I just want to conclude with—
Probably do need to wrap up.
This is my final slide. Finally, there are some, I just want to touch on a few larger structural issues. One, employers participate, as I've mentioned, in short-time compensation on a voluntary basis. And so employees, I just want to emphasize, have no right to short-time compensation when their hours are cut. And as I've already emphasized, they must establish a plan. And while employers may benefit from short-time compensation, they also may incur significant costs, the continued benefits, the higher UI tax rate. And then also, if we're going to think about comparing this to Europe, and Giulia is going to talk about that shortly, the US, unlike many other advanced countries, particularly in Europe, does very little to regulate or discourage layoffs, and does not have a culture of avoiding layoffs either. And then finally, employers in low-wage, low-skill, high-turnover industries arguably have very little incentive to use short-time compensation in given the current structure. So let me stop there.
Great, thank you very much, Sue. And Giulia, we'll turn to you now, and then we'll take questions. I have a couple questions in the chat, but please, if there are other questions that people want to discuss when the presentations are done, please send them.
Okay, thank you, Catherine, and thank you, Heather and Susan, for your presentations. What I'm going to present today is joint work with Camille Landais at the London School of Economics and Alice Lapeyre at CREST. and is work that we have prepared for the Journal of Economic Perspectives. The question that we're asking is, should we insure workers or jobs during recessions? And this has been already discussed, but one of the reasons, if you want, that motivates this work is the observation that actually the labor market policy reaction to the wake of the COVID crisis has been dramatically different on the two sides of the Atlantic. And on the one hand, we've had the US that has responded to the labor market contraction by widely extending unemployment insurance generosity, and this has come through various instruments, including, as has been just mentioned, additional payments to those that qualified for unemployment insurance, the extension of the benefits for those who would have otherwise exhausted them, and also the extension of eligibility itself to unemployment insurance to individuals such as the self-employed and gig workers. On the other side, we have European countries that have operated in a completely different way by heavily subsidizing our reductions and temporary layoffs through short-time work or similar schemes. And just to give you an example of how important this has been in Europe, in March 2020, the European Commission launched SURE, a program to sustain the implementation of short-time work programs in Europe. And in April 2020, the UK, which is a country that prior to then didn't have a short-time work scheme in place, actually created a new one, the so-called UK Coronavirus Job Retention Scheme. In this picture, you can really see visually the extent of how different these choices have been. So what this chart shows is short-time work or unemployment insurance take-up, which is the number of employees put on either short-time work or unemployment insurance as a % of the working age population in Europe and the United States. So in red, you have Europe. The solid line corresponds to UI. The solid line in blue corresponds to UI in the United States. And here you can see that it really skyrocketed since the very beginning of the pandemic. Instead, the dashed lines correspond to short-time work utilization. And here you see these diametrically opposed responses with short-time work utilization really skyrocketing in Europe. And by Europe, I mean a weighted average of Germany, France, Italy, and the UK. There are countries for which we have collected data for a long time period. And these choices, these policy choices, have not been inconsequential, because actually, if we look at how the non-employment rate, so 1 minus the employment rate, has evolved in the United States versus Europe, these different choices are really have as a counterpart the fact that the non-employment rate, again, shooted up in the US, whilst it remained actually quite stable in Europe, okay? And this is, again, a direct consequence, very likely, and I'll show you to you some evidence in that direction later, of these different policy choices. On the one hand, unemployment insurance is a policy whereby, when an employment relationship is hit by a shock, it is severed, and if eligible, the worker can claim unemployment benefits. So with unemployment insurance, what we are insuring is the worker against the cost of job loss. Short-time work instead is a different type of program. When a firm, in this case, or an employment relationship is hit by a shock, the firm, so the employer, can temporarily reduce its labor demand. So it can temporarily reduce the number of hours worked by its employees, and the employees are going to receive a subsidy for the hours not worked by the states or the Social Security. So in the case of short-time work, we're not severing the match, the employment relationship is preserved, and what is insured is the job match. Hence, the question that I was asking at the very beginning, should we insure workers or jobs during recessions? Or if you want, was the US or Europe right in what the type of policies that they have implemented? And so what we do in this paper is essentially attempting at thinking about this question. And we do this by adopting a standard public finance framework that helps us think about the optimality of social insurance schemes. In this case, it's going to be the relative optimality from a welfare standpoint of short-time work versus unemployment insurance. And so in particular, we're going to think about these two programs, not only in partial equilibrium, so not only in relation to the type of insurance that they provide to either workers or kind of the job match and the fiscal externality that they generate, but also we're going to think about how these two social insurance programs interact with inefficiencies in the labor market, pre-existing inefficiencies, and might actually affect them. And we not only consider this in a kind of theoretical way, but we also try then to think about, like, we both provide new evidence and we build on the existing literature to map kind of this conceptual framework onto the empirical evidence and try to draw some conclusions from what we know from the data. So in the remainder of the presentation, I'm going to briefly illustrate the conceptual framework and then go into more detail into its kind of building blocks, if you want, and relate them to the empirical evidence that we have on them. So as I was saying at the beginning, the framework that we will use is the standard public finance framework that informs us of the optimal generosity, typically, of a given social insurance transfer. So the optimal level of a social insurance transfer is the one that balances out its insurance value versus its fiscal cost, the fiscal externality that it generates. What is the insurance value? Well, it's essentially the social benefit of providing $1 of insurance, of transferring $1 of insurance from the good to the bad state. In the case of unemployment insurance, this is the value of providing $1 extra to unemployed workers versus employed workers. However, we know that due to behavioral responses, providing this extra dollar to the unemployed, say, is going to cost more than $1 to the government because of behavioral responses. And this is what we call the fiscal externality. So if we just balance out the insurance value with the fiscal externality of a given social insurance program, this is going to give us kind of, so the value of social insurance, that balances out these two quantities is going to be the optimal one. Now, we're not going to think about the level of a single benefit in this case, but we're going actually to think about the optimal relative generosity of short-time work versus unemployment insurance. And this framework can help us think about this. We fundamentally extend it, and rather than think about the value and the cost of a given program, we think about the relative value of, in this case, short-time work versus UI versus its fiscal externality. But as I was hinting at the very beginning, this is not the entirety of the story. This is a very partial equilibrium. When we think about the relative, or in general, the optimality of social insurance, we should also take into account the fact that when we implement a social insurance scheme, this is going to interact with both workers' decisions and firms' decisions, and hence it's going to interact with potentially pre-existing labor market inefficiencies that can be either amplified or hampered by social insurance schemes. And in this context in particular, we're going to consider three such inefficiencies: inefficient separations, surge inefficiencies, and inefficient reallocation. So by inefficient separation, what we mean is that, for instance, in the context of, when hit by a shock, firms might be induced to severe more job relationships than it's actually optimal. One reason for this, the most probably obvious, especially in the current situation, is liquidity constraints. Okay. By implementing social insurance schemes, for instance, by using short-time work, we are preserving employment relationships, and this might get us kind of closer, if you want, to what is efficient and reduce the number of potentially inefficient separations. By search externality, instead, we think about the fact that, especially again in context of during recessions, when the number of unemployed workers increases potentially excessively, this might lead to rat races for jobs among unemployed workers that may be inefficient again. And so by either increasing the generosity of unemployment insurance or providing short-term work, we might actually reduce, if you want, the search effort of workers and reduce the probability that these rat races occur. And also a much discussed topic, especially when thinking about short-term work, is the idea that kind of this scheme might interact with what is believed to be a natural consequence of recession, which is their cleansing effects. And by keeping workers attached to firms, it might prevent the efficient reallocation of workers in the labor market. So these are the types of inefficiencies that we're going to consider. Let me start by providing you kind of some evidence on the first building block of the framework, that is the relative insurance value of these two programs. So the value of insurance of a given social insurance schemes is going to depend on how workers value insurance, that is their degree of risk aversion, whether they have other means of consumption smoothing, but also the size of the shock that they experience. And in particular, the value of insurance is going to be larger, the larger the degree of risk aversion, the lower the availability of other means of consumption smoothing, and the stronger the size of the shock. In general, the literature has devoted little attention, empirically at least, to the value of social insurance programs. Recently, the literature on employment insurance has kind of made important progress in the measurement of the value of unemployment insurance. And there is consensus that actually unemployment insurance has a very positive kind of is highly valued by workers, with this value being actually quite heterogeneous across workers. But if you want, on average, the consensus is that unemployment insurance is a type of benefit that is highly valued. On the other hand, on short-term work, we really have very, very little evidence. In this work, we provide kind of some new evidence on that can help us say something about the relative value of short-term work versus unemployment insurance. With new data that we have collected in Germany, this is a survey that has been run throughout the pandemic by the IAB in Germany. We can actually shed some light on the characteristics of workers that are on short-term work versus unemployment insurance. So if you focus on these two columns, the one on short-term work versus unemployed, what you can see is that actually these two programs really seem to be covering different types of individuals. In particular, those that are unemployed are more concentrated in either a kind of the relatively younger and the relatively older ages, as opposed to those that are on short-term work. So this kind of leads us to think that these are people that are likely to kind of be a bit more outsiders of the labor market. The young, in particular, might have fewer means of consumption smoothing. It is also the case that if we look at individuals that are unemployed, they're much less likely to have a partner, and conditional on having one, they're much more likely to have a partner that is not working. So a traditional kind of channel of self-insurance, which is the so-called added worker effect, seems to be working much less for the unemployed than for those on short-term work. They also tend to have lower monthly household incomes to start with. And these are all kind of characteristics that lead us to think that these individuals might have higher degrees of risk aversion and lower means of consumption smoothing, which points to the idea that that the value of unemployment insurance is likely larger than that of short-term work. It's not only kind of the degree of risk aversion and the availability of consumption smoothing appear to be different across these two populations, but also the size of the shock that is experienced upon being put either on short-term work or on unemployment insurance. What you can see here is an event study around the time in which workers are put either on short-term work or unemployed or become unemployed. And this is based on Italian Social Security data. And you can see that both in the short and in the longer run, the type of shock that is experienced by the unemployed is much larger, okay? So this is, again, another piece of evidence, which, by the way, is fully consistent with evidence from Germany that points to the fact that the shock is larger. And hence, it's very likely, as I'm concluding on this slide here at the beginning, that the value of unemployment insurance is likely to be larger than the value of short-term work. These are traditionally measured by looking at the marginal utility of consumption or proxies of it. The second point, is the relative fiscal externality. So we're still within the partial equilibrium framework in which we want to compare insurance value with fiscal costs. So there is, to the contrary, a very extensive literature on the moral hazard effects of unemployment insurance, with an overall consensus that the costs of unemployment insurance are relatively large. On short-term work, we have much more limited effects. In theory, if you want, we might think that short-term work being typically conditional on a well-defined shock, in theory, one might worry that actually short-term work may be a type of program that is prone, if you want, to moral hazard effects, because it is hard to monitor kind of how are reductions. On the other hand, the empirical evidence that we have that comes from both the Italian context during the Great Recession and the Swiss one, again, during the Great Recession, points to limited moral hazard costs of short-term work. And one of the reasons, but probably an important one, for which we find that short-term works tend to have limited moral hazard effects is that the fiscal cost of short-term work is actually endogenous to that of unemployment insurance. Because when you have both schemes in place, by putting people on short-term work, you're actually saving on the costs of unemployment insurance. So in terms of costs, again, this is based on the evidence that we have, but it's likely that actually the fiscal cost of short-term work is smaller than that of unemployment insurance. That said, the evidence again comes from a context, the Great Recession, in which we thought, if you want, that the use of short-term work was really massive, but this has been really outpaced in the current pandemic. So let me move instead to think about the more general equilibrium framework and in thinking about how these social insurance programs interact with inefficiencies in the labor market, starting with inefficient separation. So the question that we ask here is, first of all, short-term work is a type of program that is put in place in order to preserve matches. We said that it's a program that ensures jobs rather than workers. So the first question that we need to ask is short-term work really kind of capable of saving jobs? And if we establish that indeed short-term work saves jobs, then the next question that we need to ask, is this actually inefficient? In other words, would separations be inefficiently high in the absence of short-term work? If the answer to this second question is yes, then we can actually claim that short-term work helps us reduce inefficiently high separations. So I'm going to start by kind of trying to answer the first question: does short-term work save jobs? And here I'm showing you some new evidence that we have produced. This is cross-country evidence in which we essentially show the relationship between the change in the non-employment rate on a year-on-year basis between the second quarter of 2020 and of 2021 as a function of short-term work take-up across a set of European countries and the United States. And you can see that there is this strong negative association between the amount of short-term work take-up and the change in the non-employment rate, which points to the idea, again.
Can I just ask you a clarifying
Yes.
question? What is the non-employment rate?
It's measured as 1 minus the employment rate.
So it's over,
So
the denominator is population.
Yes.
Got it. Thank you.
Yes. So what this shows, again, we're not interpreting these as causally, but actually shows a strong negative association between the utilization of short-time work and, if you want, the preservation of employment. And this is evidence that is actually in line with kind of better identified, definitely evidence that, again, comes from work that has been done during the Great Recession in Switzerland, in France, and in Italy. All this evidence that comes from the Great Recession points kind of in the same direction, that short-time work works in the sense that it saves jobs. Is this efficient? Well, here we need to think about kind of, whether in the absence of short-time work, the number of separations would be inefficiently high and why it would be so. On the one hand, we may think, well, matches are valuable for firms. They're valuable because it is costly to dismiss workers. It's costly to hire them. It's costly to train them, especially when, for jobs for which they need to acquire specific human capital. Matches are also valuable for workers because we know, and actually Till von Wachter has done a lot of work on this, we know that unemployment is associated with longer scarring effects. So the question is, why wouldn't workers and firms try to preserve matches, or why wouldn't firms try to hoard onto their labor, even in the absence of short-term work? Well, here the problem is that they may face a set of constraints, in particular liquidity constraints, that might prevent them from being able to hoard onto their labor optimally. And we have evidence, again, from Italy in work that I've done with Camille Landais, that indeed liquidity constraints appear to be a very significant factor that correlates with the take-up of short-time work by firms. So those that were already before the Great Recession facing strong liquidity constraints are those that took up more during the recessions, and are also those that benefited more from short-term work. So certainly liquidity constraints are one kind of element that might lead firms not to hoard onto their labor optimally. So it's kind of plausible actually that short-term work not only saves jobs, but does so kind of efficiently. So actually brings us kind of closer to what the optimal level of employment, if you want, is compared to what could be achieved in the absence of short-term work. So let me turn now to a second dimension with which the programs might interact, which is search inefficiencies. So recessions are typically, and we'll discuss the current context, but typically they're characterized by labor market slack, so low tightness as measured by vacancies over kind of aggregate search effort. This is because recessions are typically times in which many workers search for jobs and firms tend to post few vacancies. Having especially low tightness might be socially inefficient because it might lead to these rat race externalities that essentially reduce the job finding probability for workers, given that a lot of them are really searching at the same time. Social insurance, and here I'm talking both about short-term work and unemployment insurance, might affect equilibrium tightness by both affecting workers and firm behavior. On the worker side, by reducing their search effort, and on the labor demand side, by kind of potentially increasing the number of vacancies that they post. So the welfare consequences of short-term work and unemployment insurance in this direction really kind of depend on, again, two questions similar to the ones that we were asking before. So the first is that, do short-term work and employment insurance affect tightness? And if so, in which direction and with what magnitude? And the second is tightness inefficiently low to start with in the absence of short-term work and employment insurance? And we try to answer these two questions again in turn. So regarding kind of the association between short-term work take-up or unemployment insurance take-up and tightness, in the paper we provide some new evidence on this association by constructing a measure that captures inversely tightness. In particular, we construct a measure that is comparable across countries of the probability of fill vacancies. This is an inverse measure of tightness. And we correlate that with short-time work take-up. This is the panel on the left, and unemployment insurance take-up, the panel that you see on the right. So again, these are not very strong associations. And again, these are just associations. We're not interpreting them causally, but you see that there is a negative association between either short-time work or unemployment insurance take-up and the vacancy filling probability. So in other words, both short-time work take-up and unemployment insurance are associated with an increase in tightness. So both schemes seem to be kind of capable, if you want, to generate potentially an increase in tightness. But is tightness excessively low to start with? Well, typically in downturns, tightness is typically low. So pushing it up and increasing the job finding probability of workers is especially desirable. But how about the current recession? Well, we have, here I'm showing you data from the US. This is again, the evolution of what we call Q theta, so the vacancy filling probability in the United States from 2001 up to the second quarter of 2020. And you see two series, because here we are plotting our Q theta series in blue by looking at all hires, and in red instead by considering only hires without recalls. So by considering only hires that do not come from unemployment spells where the worker was expecting to be recalled by the employer. So what you can see is that if you consider kind of the red series, so excluding workers that were put on UI but were expecting to be recalled, actually, it seems that this recession is really quite unique. It's a recession in which the vacancy filling probability has dropped dramatically, and so the labor market is especially tight. And this is not true only for the US. We see similar type of behavior also in other countries, and in particular here I'm showing you a set of European countries. So it doesn't really kind of seem to be the case that the different types of programs led to different types of outcomes kind of in this respect across the US and Europe. So let me touch on the last point that I wanted to mention, which is reallocation. So reallocation has been kind of a topic that has been really broadly discussed during the current crisis, especially in Europe, given kind of the massive extension of short-time work. There's been substantive kind of worry that these massive short-time work extension would prevent kind of efficient reallocation in the labor market. So both unemployment insurance and short-time work, however, are schemes that can interact with reallocation. It's just that the type of reallocation that they hinder is different. We can think of UI as being a break to aggregate reallocation because it reduces aggregate search effort. Short-time work instead is a break to sectoral or firm reallocation because it prevents workers from switching from specific like firms or sectors that are hit by productivity shocks to other sectors that might be or firms that might be more productive. Now, how serious are these reallocation effects? Well, actually, to the best of our knowledge, we really don't have a sense of what the reallocation effects are of unemployment insurance. For short-time work, we have some evidence that again comes from the Great Recession in Italy, which suggests that in a context such as the Italian one, in which the shock became permanent, there is negative selection of firms into the program that can have negative reallocation effects. I'm going to show you here evidence of this, in which essentially what we plot is the change in firm size, so firm growth, if you want, among firms that were not eligible for short-time work as a function of, this is a positive function of the take-up of short-time work And this is a bin scatter plot at the local labor market level. And you can see that in those local labor markets in which short-term work take-up was larger, there has been slowest, kind of less growth in employment in non-eligible firms. And this actually translates also in lower total factor productivity growth. So these reallocation effects are present, but when we quantify them back during the Great Recession, they're actually relatively small. What can we learn from this? Well, actually, the current situation is actually different in two respects. On the one hand, there's probably less reasons to believe that during COVID, there's been negative selection of firms into the program because the shock has been orthogonal to pre-existing productivity levels. But on the other hand, there's been a massive extension and prolonged utilization of short-term work. So it's unclear actually how we can, what's, if you want, the validity of these results that we have from the Great Recession for the current situation. And I won't touch on them because of time, but of course, these are just kind of the three main sources of inefficiencies that we have identified, but there are other externalities with which these programs interact, and maybe we can talk about these during the discussion. So let me just conclude. Kind of what we do in this paper is provide a general framework to think about the relative kind of welfare desirability of short-time work versus unemployment insurance. The conclusions from the evidence that we have is that unemployment insurance seems to have greater insurance value than short-time work, but likely also greater fiscal externalities. So in that sense, probably in partial equilibrium, the two sort of balance out. Short-term work is definitely a scheme that is useful to prevent inefficient layoffs. And again, at least from what we know from the Great Recession, this is coming with limited reallocation effects. Unemployment insurance, on the other hand, might be more effective at reducing search externalities. So if you're still kind of wondering who was right, who was wrong, well, our reading kind of again, what the evidence that we have collected is that probably we should start to think a bit more about short-term work and unemployment insurance as complementary programs rather than kind of opposites, like two extremes. Why? Because they tend to insure different types of individuals. They also tend to trigger different types of moral hazard responses. And again, both seem to be effective. UI probably a bit more at reducing search externalities, but again, they have other types of effects when it comes to preventing inefficient layoffs and reallocation. So again, probably it's worth thinking about the two more as complements, as complementary programs that in particular that have different types of roles during recessions from kind of the beginning and when the recessions might become a little more prolonged and more permanent. And with this, I'll conclude. Thank you.
Great. Thank you very much. I would like to open the floor to questions for the panelists or comments that people may have. Eliza Forsyth, if you are on the line, if you had a couple of questions, why didn't I let you ask your questions instead of my summarizing it?
Great, thanks a lot. So actually, I have another question that I want to ask that just came up with for Giulia, which is a really interesting paper. And I guess, so one of the things that I think makes it tricky kind of studying between different countries, and especially during the COVID period, is just that sort of people that are in the same situation get labeled differently based on sort of the policies, right? So in the United States, we had a lot of people that they maintained a relationship to their previous employer, but because of the policy arrangement, they separated, went on unemployment insurance, they were on temporary layoff, and then most likely they returned to their previous employer within 2 to 3 months, right? And so it seems like some of this comparison between different policy regimes, employers are actually making the same decisions in terms of, from the employer's perspective, the decision to put people on temporary layoff signals that they don't see this as a reallocation shock, right? They say, I want to maintain my workforce and I'm going to bring them back, right? Which is what we saw a lot of employers doing in the US. if they had more access to short-term compensation or better some of these policies in Europe where you can actually just keep people on payroll, they probably would have done that instead, right? And so I guess, I feel like some of these comparisons that are being made, it's a little bit tricky because the data is showing really different outcomes when it's really mostly about sort of how are you funding these things.
Thank you very much. This is an excellent point. I should have probably emphasized this earlier. Actually, again, we tend to think about short-time work versus unemployment insurance as too extreme, but there's really kind of a continuum of policies there, right? That go from including kind of exactly what you were saying, either temporary layoffs or partial unemployment insurance in the US that actually serve some of the same purposes of short-time work in European countries. I don't think that still kind of it's useful, I think, to think about the types of insurance, if you want, that these schemes offer, because again, there's a continuum there, and all of them offer the same degree of insurance. So, for instance, if you think about like temporary layoffs, these essentially, at least to my understanding, provide insurance only on the extensive margin. Right, so they only allow individuals to be either on work or off work. Short-time work schemes tend to have the advantage to allow both partial or full hour reduction. So really kind of allowing flexibility there to be kind of more, there's a lot more flexibility. So workers can be put either on reduced hours or on 0 hours essentially. And there's another element, and here I would be very kind of interested to also hear your view, which is when workers are put on temporary layoffs or recall, kind of what's the extent to which that can be really enforced? When it comes to short-time work, it's kind of easier if you want, I think, to make them conditional to kind of the prohibition of dismissals, and so to really kind of prevent the job relationship. Whilst I think this enforcement margin might not be there with temporary layoffs or recalls. Yes.
If I could just,
go ahead.
Sure. Just to respond to Eliza, I wanted to push back slightly on this notion that what we observed in the United States was a lot of people, kind of being put on layoff and then coming back, 2 or 3 months later. If we think about the industries that were hardest hit, yes, of course, many of them did go back to prior employers, but a lot of them didn't. The turnover is extraordinarily, many of them are now on the job for more than 2 or 3 months. These are very high turnover industries. And I want to emphasize, and I did during my talk, but the short-time compensation, maybe Giulia can speak to whether it's different in Europe or not, but it's really designed for skilled employees that employers want to retain. It's just basically not used for the sorts of workers that were hardest hit by the pandemic recession.
Yeah, and I would add too, Susan, I think that's it would be interesting to look also at, whether people have health insurance or not, and whether or not there's a union involved in the approving the plan or not, because that might also be a motivating factor in terms of, if an employer, better probably what the characteristics of the employers are using STC, but if they have health insurance and they're unionized, the workers might be pushing them more toward using STC than UI, but I don't know. It's probably a good, research question.
Alexander, did you have a comment?
Oh yes, I would be happy to comment. I mean, in Germany, short-time work traditionally is always has been part of the unemployment insurance scheme, so you can't separate them. So it's a tool which is paid for mainly by social security contributions, half of the employers and half of the employees. So in that sense, it's not directly an either or. So I like in that sense very much Giulia's conclusion that they are not substitutes, but they are complements and aim in that sense at different things. But I would like to add two additional things. I mean, even when you compare short-time work schemes in Europe, there are quite huge differences. To my knowledge, for example, in Italy, it's very common that workers on short-time work have a reduction in working hours by 100%, which is very uncommon in Germany, for example. I mean, we experienced that now during the pandemic, simply because we had to close down firms and economic activity. But in Germany, it's very uncommon to have a reduction in working hours by 100%. So in that sense, people really continue working. And with respect to Giulia's numbers, you showed numbers, differences between people in short-time work and people who became unemployed. I'm quite sure, but only to make sure, did you take into account that people on marginal employment are not eligible for short-time work, because you have to pay social security contribution to be eligible to short-time work? So in that sense, for example, younger people in part-time employment, students and so on, we know that they were not secured by short-time work, which is a debate in Germany, whether we have to change our scheme. And I would like to know whether this is already included in your numbers.
So yes, so actually, I mean that we are excluding the marginally employed from the table that I showed, and the table is purely descriptive. So absolutely, I mean, on the one hand, I think it's one of the purposes is actually to emphasize the fact that these categories of workers are really different. Okay, so there is different selection, if you want, on these two schemes, but the other side of the coin is that indeed we're comparing kind of different groups. And so, yeah.
Can I make one more comment? I mean, it was very right, what Katharine, what you said in general, that the groups are very different. Traditionally in Germany, short-time work was very much a thing from large companies in the industrial sectors. But one of the success stories during this crisis was really that the government managed really to motivate the services sector to use short-time work, and we have large percentage uptakes of short-time work in service sector, where we would have never thought that they would use short-time work, but they did. But of course, on the other hand, related to Giulia's work, it comes at a price, because you have to make short-time work financially more attractive. That's what we traditionally do in Germany. During recessions. We change the regulations to make it attractive to take it up.
Absolutely.
This may be a good time, Eliza, if you don't mind, to bring up your earlier question, which is sort of more general, which is, why would you use, you should ask the question about STC versus PPP.
Right. Yeah, sure. Yeah. So in the United States, we had a lot of policies that we did all at the same time, right? Which, you know, to see the efficacy of different things. But one is this PPP program, which was basically giving loans to businesses with the idea for them to retain jobs. And to me, it seems like in some ways that's sort of doing some of the same things we hope would happen with the short-term compensation. But I was just curious for the experts in the room, you know, how you think about sort of structuring things this way versus the STC way versus, you know, the efficacy and obviously the cost. So just any thoughts on that?
I said other people have thoughts. I have one thought, which is, if you could set up a short-time compensation system that worked more automatically, that where employers who needed to cut back on hours could say, this is what we're doing, and start doing it right away, it would give you a much quicker way to respond to a negative shock than if you have to set up a vehicle for making loans and have people apply for them and so on. So I sort of see, I don't see these as conflicting necessarily. Again, I think they're somewhat complementary, but I think there are some advantages potentially to a well-functioning STC program as compared to something like the PPP. But Sue, I suspect you have thoughts about this too.
Yes, I did. So just at a high level, I think Giulia emphasized various inefficiencies in the labor market and so forth. Another type of inefficiency that I emphasized in my talk was bureaucratic inefficiencies, right? And those played very prominently during the pandemic recession and earlier. To answer Eliza's question, why was PPE even used? Because there was little confidence at the federal level at the time that state unemployment insurance systems could handle it. So they were looking for other ways to get money out, to pump money into the economy. PPP was one of them, the payroll protection program, also these checks that the Treasury sent out to low and middle income people. I thought Katharine might mention in this, making STC a bit more automatic. We'd be remiss to say, to not acknowledge the fact that the UI system in the United States has partial unemployment insurance program that operates in every single state, but it's very generous. It isn't, your hours have to be cut back by quite a lot for you to apply for partial UI. Another way around the STC kind of bureaucratic mess of applying for it would be instead, whereby employers have to approve this plan, would be to expand partial UI, make it more widely available automatically to workers, and you avoid this STC plan. In fact, Katharine, you want to say something about it in the remaining minutes, but I believe Vermont has done that or is moving in that direction.
Vermont, so there was a little disagreement in our presentations about how many operational STC programs there were there 25, were there 26? It's because Vermont has kind of moved away from doing this and instead made their partial unemployment compensation much more generous. You can get partial unemployment benefits even if you're earning a lot more. In most states, you can't get partial unemployment benefits if you're earning more than your benefit amount, basically, or a little bit more than your benefit amount. In Vermont, you can get them if you're earning, I think it's twice your benefit amount. And in effect, what it's doing is letting people on partial UI collect what they would have collected if they'd been on STC. And maybe that's a better way to go.
Was that motivated by
It was motivated,
kind of
as I understand. It was motivated, as I understand it, by the legislators in Vermont, or the state people administering the program, feeling like it was really cumbersome. Is my understanding.
Right.
Maybe Giulia or somebody could say how the STC programs in Europe work.
Yes,
they have to be employer approved, et cetera.
Yeah, before that, if I may just add one point to the 2 points that have already been made, kind of the expediency and administrative simplicity. Another one is targeting, that I think is a very good property of short-term work, because it kind of naturally it targets firms that are, if the purpose here is to kind of insure jobs, short-term work has better targeting properties than PPP type programs, because it really targets directly firms that are hit by a shock and hence want to reduce their hours in that case. So I think that is also another aspect. Kind of for what concerns the way in which the programs tend to work in the UK, this is pre-COVID though. Typically, yes, it's kind of the employer has to apply. That's the case also in the US, and they have to provide a recovery plan. In terms of the financing, this is typically in usual times, the subsidy is advanced by the employer to the workers, and then the Social Security is going essentially to refund the employer, typically through reduced contributions. There's also kind of the possibility that the Social Security directly pays out the subsidy to the worker, but this is usually in more kind of severe, when really the firm is kind of unable to do that. During COVID, however, and this has been true across all countries, the need for a recovery plan and agreement has been waived, and so firms should just invoke a force majeure or kind of COVID-19 in this case to access the program. And there have been different kind of ways in which the funds have been provided to the workers. Of course, firms lack liquidity. And so there have been agreements, for instance, in Italy with banks that would essentially grant a loan to workers and would then be reimbursed. The loan would be paid by the Social Security if kind of the employer's application would be approved.
Well, I
hope this answers the question.
Yeah, thank you. That was great. I think there is more discussion we could have, but we are unfortunately out of time. So I would like to thank all of the panelists and the people who raised questions for a really interesting and useful discussion. This raises big issues about how we think about responding to economic crises, and I think there's been some very useful information and thoughts about that. So let me just thank you all and conclude the session. So
Bye-bye.
Thank you for chairing the session, Katharine. Bye.